All right, so here we are with Chapter 7, and Chapter 7 continues kind of our discussion of the taxation of corporations. And when we say corporations, we're talking about C corporations specifically, okay? It's also important to note that Chapter 7, we're kind of constraining what we do in Chapter 7 to the topics in this PowerPoint and in the practice problems and in the homework. So you can use this PowerPoint especially as kind of a guideline regarding the topics that are going to be covered in Chapter 7. Okay, so the first thing that we need to talk about are corporate distributions. Okay, and so we know that when a corporation is distributing profits to shareholders, they're going to be taxed in a couple of ways, or they can be taxed in a couple of different ways, okay? And so they can be taxed as income, all right? And that would be if they were a dividend, right? A tax-free return of capital, okay? And this is if you're having funds distributed, but there's not enough earnings and profits, right? But you do have enough basis in your stock, or they can be taxed as a capital gain, okay? We know that when corporations distribute income to shareholders, that lots of times this creates double taxation, okay? There are types of income that are distributed that do not create double taxation, right? Things that are deductible, salary, loans, property, those kinds of things. So they must be reasonable in amount, and they must be ordinary and necessary according to the tax code, all right? If you have an unreasonable payment, then lots of times that can be viewed as a constructive dividend. All right, and so lots of those things I just talked about are actually in this slide. So we will move on from here. All right, so maybe a new topic that you've not had a lot of experience with previously are earnings and profits, okay? So when we say earnings and profits, what are earnings and profits? Okay, I'm going to kind of move this up a little bit. And so earnings and profits it's a measure of a corporation's economic ability to pay dividends. All right. So remember that it's an economic ability to pay. So we're going to start with taxable income and then make some adjustments. All right. So how are things determined to be a dividend? Well, in the past, we've paid dividends, and you know that dividends reduce retained earnings and they don't impact net income. And we have all this information about dividends, but we've never really thought about what is treated like a dividend for tax purposes. And so that's what one of the key topics that we hope to get out of this chapter. All right, so essentially, it's treated as a dividend for tax purposes if the distribution, and it says of property, but remember property can be cash, right? Is made out of its earnings and profits. And that can be either current earnings and profits or accumulated earnings and profits, okay? And how do we get this accumulated earnings and profits? Well, that's the balance of earnings and profits left over from all the previous years, okay? All right, so this slide does a great job of laying out the process to calculate current, that's what that C stands for, earnings and profits, okay? And so you've got all of these steps, and you'll notice that these are pretty general, as is listed in this slide, but the next couple of slides are going to give us very specific definitions and examples of things to put in with this. All right, so let's go on to some more specific terms. All right, so again, we're computing current earnings and profits. Okay, so we're going to start, this is your starting place. All right, and then we're going to add things that were excluded from taxable income. Why? Because remember, earnings and profits is your economic situation, and tax-exempt interest absolutely, right, impacts your economic situation. Okay, so all of these things are additions to taxable income in order to get to earnings and profits. Again, this is to get to current earnings and profits, all right? And we're going to add back deductions that were allowed for tax, but not for E&P, okay? So they reduced our taxable income, but they shouldn't reduce our earnings and profits. So these are items that we are going to add back. All right, so now we have this whole list of items that we need to subtract, okay, because they are deductions that were allowed for earnings and profits, but not for tax purposes, all right? And so there are some notable things here, right? Federal income taxes, that's kind of notable, okay? Expenses on the earning of tax-exempt income, all right? So your excess charitable contributions. So these things you get to subtract because they were not deducted for tax purposes, but you are going to deduct them for earnings and profits because they change your economic situation, even though they don't change your tax situation. All right, so we've talked about the items that are always either an add back or a subtract. And now we get to the items where it's an add or subtract. And these are timing differences. And these are, again, differences between taxable income and earnings and profits. So I'm going to slow down a little bit here because I'm going to add some detail. And I don't know that I'm going to be able to write it all down, so I'll talk slowly as we go through each one of these bullet points, okay? So let's talk first about deferred gain on installment sales, okay? You're going to add deferred gain in the year of sale. So add in year of sale. But, hold on, I'm going to try to expand this a little further. Okay, but you're going to subtract recognized gain in subsequent years. Okay, this is going to get a little messy, but I'll talk slowly and write notes when it makes sense, and we'll add some details here. Okay, so and then let's talk next about depreciation. Okay, so depreciation, and we're not talking about Section 179 here. We're talking about tax depreciation, okay? So if tax depreciation exceeds E&P depreciation, then we have to add back. All right, so let's just write it that way. So add back tax depreciation, okay, other than Section 179, okay? Now, it's also important to note that bonus depreciation is not allowed for E&P. Okay. Now, what about Section 179? So let's talk about Section 179 really quickly. So for E&P purposes, okay, Section 179 is deductible over 5 years. So what you're going to do is add it back in the year of Section 179, but subtract in subsequent years. So add back Section 179, but subtract in subsequent years. So remember, for tax purposes, you get to fully depreciate, right, items with Section 179. But for E&P, there's no immediate expensing. It's a 5-year expense situation, okay? Let's talk about inventory. So we've got inventory down here at the bottom, okay? Inventory, if LIFO is used for tax purposes, you have to use FIFO for E&P purposes, okay? So FIFO must be used for E&P. We need to talk about long-term contracts. All right, so let's talk about long-term contracts. So here it's referred to as completed contract. You can also have the percentage of completion. Okay. So let's do down here. Long-term contracts. Okay. So for E&P, you have to use percentage of completion. All right, so what does that mean since you have to use percentage of completion? What that means is you have to add back if more income is recognized under completed contract method. All right, so I'll write that down. So add back if more income is recognized under completed contract method. All right, I'm going to move up a little bit. Okay. And then what if more income was recognized under the percentage of completion method? Well, then you have to subtract. Subtract if more income was recognized under percentage completion method. All right. I don't think we talked about depletion much, but for E&P purposes, you have to use cost depletion. So whatever adjustment you make, you're going to have to make it so that you're recognizing cost depletion for E&P. All right. All right, so this slide talks about the ordering of distributions, okay? And then the next slide, we have an example. So let's take a look at our example, okay? All right, so what do we see? Well, we have current earnings and profits of $1 million. We have accumulated earnings and profits of negative $500,000. The corporation distributes $1 million on July 1st. What is the dividend, if any, to the shareholders? Okay, well, remember that the distribution is going to be a dividend to the extent of earnings and profits. And we can leave that statement there for right now. And the good news is we have plenty of current earnings and profits to absorb the distribution. So the dividend is $1 million. Okay, now let's go on to the next example. Okay, so now we have current earnings and profits that are negative and accumulated earnings and profits that are positive. And the corporation still distributes that $1 million on July 1st. Okay, so now what do we have? Well, what we have now is a situation where current earnings and profits are negative, but accumulated earnings and profits are positive. Okay, so what we have to do is the net earnings and profits are apportioned on a per day basis. So what does that look like? All right, so accumulated earnings and profits as of July 1st equals the $1 million, that's the accumulated, minus 1/2 of the minus 1 million, that's the current, which equals 500,000. So how much of that can be treated as a dividend? Well, the answer is 500,000. Okay, so what about distributions of non-cash property? Okay, so distributions of non-cash property, you look at the money received, right, the cash, plus the fair market value of other property received, minus the liabilities assumed by the shareholder, and that equals the amount distributed. Okay. Now, what about the corporation? Okay, if you're paying a non-cash property as a dividend. Okay, so the corporation is going to recognize the gain. If there's a loss, the corporation does not get to recognize the loss. Okay, and gain is fair market value minus tax basis. Okay, if the property's fair market value is less than the liabilities assumed, then the fair market value is deemed to be the liability. So make sure you keep track of that just in case you have some kind of upside down situation. All right, let's look at this third example now. So shareholder receives a property distribution from Sunny Corporation with a fair value of $200. Share assumes a $100 mortgage attached to the property. Sunny's basis in the property distributed is $100. Okay, so Sunny Corp recognizes what? So they're going to recognize a gain, right, of $100. All right, so that's going to be fair market value was $200 minus tax basis, which is $100. Okay, now what about share? Share recognizes a distribution of fair market value minus liabilities assumed. Whoops. All right. And that was, okay, now this $100 distribution, we don't know if that's treated as a dividend or not, right? Because we don't know what the EMP situation is, okay? But that tells us at least how much value is associated with that distribution, okay? All right, now let's look at a slightly different situation, but very similar, okay? So what if they receive property with a fair value of $200 and share assumes a $300 mortgage attached to the property and Sonny's basis in the property is $100, okay? So now, how much is the gain? Okay, so now remember, when the liability is larger than the fair market value, then what ends up is you take that liability minus the tax basis. And so in this situation, they would have $200 of gain. This last slide talks just a little bit about partial liquidations. And it talks about how a corporation can contract, okay? So they can either distribute stock of a subsidiary to shareholders, or they can sell a business and distribute the proceeds in a partial liquidation, okay? And then you've got some rules about distributions. I just wanted to put this in there because you can have a partial liquidation of a corporation, but that is not going to be particularly important to us at this stage of the game. All right, so that completes our Chapter 7 lecture coverage.